When the market is crashing and everyone's panicking, there are really only two types of investors: those who sell everything and run for the hills, and those who keep buying while everything's on sale. Today, I want to show you exactly why buying the dips works and the biggest factors why asset prices keep climbing higher no matter what chaos is happening in the world. First, let's define what we're talking about. Buying the dip simply means purchasing investments when the market is down, which lowers your average cost basis on the investments. Think of it like shopping during Black Friday sale, except instead of discounted consumer items that depreciate in value, you're getting discounted assets which value will appreciate over time. Now, here's where things get interesting. Buying the dips during Warren Buffett's early days was different than buying the dips today. Back then, when you bought a crash, you might wait years before seeing profits. These days, it seems like you can barely lose money even in the short term when you buy major dips. This is because since 2008, investors figured out something crucial. We now have central banks actively backing the system during crisis. Back in 2008, when investment bankers had leveraged up and basically gambled away our entire financial system, we were headed for what economists called a prolonged deleveraging. That's a fancy way of saying the economy was about to shrink for years as everyone paid down debt. Without the Federal Reserve and other central banks stepping in to bail out banks and pump money into the system, anyone buying that dip would have waited much longer to see profits. Currently, people are worried about the most recent manufactured bear market. In April 2025, Donald Trump launched a tariff war against the world that caused the S&P 500 to drop 20% within 3 weeks. But just to put this in context so you'd understand how powerful these central banks entities really are, during the COVID-19 pandemic, the entire world really shut down. Planes stopped flying, stores closed, people stayed home for months. And yet, central banks were able to prop up the markets with money printing and what economists called helicopter money, essentially dropping cash directly into the economy. The result of that, if anyone remember, the market not only recovered but hit new highs while the world was still largely locked down. So if central banks could lift us out of a global pandemic where the entire economy stopped functioning, a tariff-induced sell-off will be manageable. Another fundamental reason why buying the dips has always worked throughout history, it is that as long as we have functioning capital markets, you've got internal battles between greed and fear, buyers and sellers. There will always be a price low enough that buyers will step in. Capital markets naturally allow for innovation and expansion. Companies grow, economies expand. In addition, we now know that central banks will always keep printing new money, which puts a constant rising floor under asset prices. So over the long term, markets keep expanding upward. This assumes, of course, that we maintain functioning capital markets and central banks continue their supportive policies. For revolutionary abolitions, we have 3 examples. Those are Russia in 1917 with the Bolshevik takeover. We have China in 1949 with the communist victory. And we have Cuba in 1959 with the Castro Revolution. For wartime destruction, we have Nazi-occupied Europe and we have wartime in Japan. For political collapse, we have Soviet Union dissolution in 1991. For hyperinflation examples, we have Weimar Germany in the 1920s, and we have Zimbabwe in the 2000s. For extreme authoritarianism, we have North Korea ongoing. But even in these extreme cases, capital markets eventually return because they're a natural development of the advanced civilizations. Human needs to trade to expand production and improve quality of life. It's literally how we progress as a society. In our current system, where asset prices are supported by money printing, buying dips has worked incredibly well, even over short-term periods. If the stock market was a person, it used to have the patience to watch long YouTube videos, and now it just watches TikTok. Everything happens faster, including recoveries. Let me share some compelling data from JP Morgan's research on buying the dips or simply staying invested and not chickening out when the market is going down. The first one is the cost of bad timing. Missing just the 10 best trading days over a 20-year period dramatically slashed total returns. 7 of those best days happened within just 2 weeks of those 10 worst days, which means once you can't take the pain anymore and sell, you're almost guaranteed to miss the biggest part of the recovery. The average investors, that's someone who buys high and sells low due to emotions, underperformed a simple 60% stock, 40% bond portfolio by 3.5% per year. On a 100,000 investment over 20 years, That emotional decision making cost $170,000 in missed gains. Since 2017, despite COVID, inflation, war, and political turmoil, the S&P 500 more than doubled. Here are some S&P 500 recovery patterns. After every major US bear market, that's a drop of 20% or more, the S&P 500 didn't just recover, it hits new highs. 2008 to 2009 crash. It went down 57% and fully recovered within 4 years. COVID crash in 2020. It went down 34% in 1 month, recovered in under 6 months, ended the year up 16%. The historical average return 1 year after a bear market bottom is 47%. Bear markets happen about every 6 years since 1928. Yet over any 20-year period, the S&P 500 has never produced a negative return, not once. Now, I'm not saying buying the dips is risk-free or that markets only go up. What I'm saying is that if you understand the system that we're operating in, one with active central bank support and functioning capital markets, the historical evidence overwhelmingly supports staying invested and buying when others are selling. The key is having the psychological fortitude to buy when everything feels scary and the financial discipline to stick with your strategy. Because at the end of the day, buying dips isn't just about timing the market. It's about understanding human psychology, economic systems, and having the patience to let compound growth work in your favor. Remember, time in the market beats timing the market. But buying dips while staying in the market, that's where the real wealth gets built. So what do you think? Have you ever bought a major dip and regret it? Or missed one and wish you hadn't? Let me know in the comments below. And if this video has provided great value for you, please drop me a like. That will be greatly appreciated. My name is Luke and I'm a financial planner by day. Thanks for watching my video and I hope to see you on the next one. Take care.